Not a good day in India to start this week. The currency crisis there accelerating. The rupee, another all-time low. The Reserve Bank of India burning through reserves at an unsustainable pace. The stock market crashing. The Sensex down more than 1,000 points today alone. The government marking down its expectations for growth by quite a lot. And then saying that the import numbers that they reported for November, no, they're going to revise them sharply too. The horrific trade deficit in November, which those imports created, those had helped explain the rupee's crash. Now the Indian government says, oh no, our bad. Apparently customs officials somehow double counted $5 billion in gold imports. That seems like it would be pretty hard to do, and it's tough to ignore the timing here, with the rupee screaming lower and officials desperate to break what they think is a psychological link to the rupee's weakness. There is no shortage of short-run reasons for that weakness. Trade wars are at the top, as is the Federal Reserve and its interest rates. The rupee is more than those, however. It's a canary in the coal mine for global health or global sickness, as the case may be. And the lower it goes, the more you know there is more supply shock downside yet to come. That's what none of them can figure out. Why they keep changing their tactics as well as their excuses. Why none of those ever seem to work. Governments all over the world responded to their own lockdowns with what they called stimulus, which only created an illusion of recovery. What they were all expecting was that the private economy would pick right up when it couldn't possibly have done so given all of those monstrous distortions. Starting with the forced price changes that impoverished regular people all over the planet, those who were not fortunate enough to be well connected. So everything from stocks to currencies are struggling because the world has to come to grips with the fact that we are not done with the early 2020s. The entire system still has to adjust from those artificial highs of the previous years and then come down to no one knows what as the fundamental baseline. And that right there is driving all of this uncertainty, to put it kindly, across all of these markets. In fact, trade wars are one of those adjustment processes, the Trump administration's own way of dealing with the sick American economy. Far from being an exception, India, like Brazil, is the poster child. Falling currency, crashing stocks, flummoxed officials, fake data, monetary illiquidity. It's got it all. And it starts with the fact that we have distortions in the marketplace that need to be corrected, that create more distortions because governments don't want that correction to take place. And it's gotten to the point in India where even the stock market is being drawn into the growing mess. The stock market today, according to this report, crashed upon open on Monday, January 13th, dragged down by real estate, financial services, and consumer durables stocks. The Sensex was down over 1,000 points, and even the Nifty 50 fell more than 300. Behind the weaknesses, a lot of concerns, starting with the currency that continues to go lower and lower. As of today, the rupee hit 86.71. It looked like at one point it was going to get all the way to 87. It had been 86.20 to end last week. And it was 85.58 at the end of last year. So it's accelerating very visibly to the downside. And it started, as I said in my last video on India and the rupee, it started at the end of November, along with a whole lot of other things around the financial world. And during that time, going back to October 4th, the Reserve Bank of India reports that it has blown through some $70 billion worth of its foreign official reserve. Now, some of that is changes in market value as the value of bonds has gone down again as interest rates rise. But even so, 10% of its reserve base has disappeared since early part of October as the Reserve Bank of India tries to combat that tremendous and growing weakness. But as it realized the non-deliverable forwards and trying to hit speculators in that marketplace, we realized that wasn't working. Reserve Bank of India was forced to more direct intervention, which meant selling US dollars in the local marketplace and buying rupees with the proceeds. But in doing so, that meant that taking rupees out of the local marketplace, leaving the system, especially this time of year, unusually illiquid. And that's caused more strains I talked about previously as well. In fact, there was a report just today, the Reserve Bank of India had used swaps to inject rupees on Friday to the tune of about $3 billion in several different auctions at different maturities, 3, 6 months, and I believe a year. So the distortions are creating government interventions that create more distortions that create more government interventions, and it leads to increasing chaos and volatility in currencies, in stock markets, as well as everything else related to them. Now, last month, the Reserve Bank of India went through a leadership change, and it was pretty much short notice, which is not unusual. That's how things go at the RBI. That's how it's structured. But incoming Governor Sanjay Malhotra, nobody really knows what his policies will be, either for the exchange value or even internal interest rate policies for that matter. But there's a lot of speculation, pun intended, that he intends to do things very differently than Das had. Now, Das had focused on dampening down volatility in the exchange value in order to try to create a more predictable environment for either the export business or financial flows in and out of India. Now, that didn't work, obviously, because the economy gets weaker, the rupee continues to get weaker, nothing seems to be halting the slide, nor arresting the economic problems that go along with it and the financial problems that come along with it, too. So the idea is that Malhotra may come in and rather than focus on maybe enforcing a crawling peg to the US dollar as Das had, to allow the rupee to fluctuate more freely, which in many ways means allow it to fall potentially much faster, which some suggest and some are speculating that this means that the Reserve Bank of India, the Indian government overall, are seeking to let the currency go lower as a means to increase exports, an export stimulus policy by allowing the currency itself to adjust downward, maybe where the market has been trying to send it for the last couple of years when it had been artificially suppressed by Das. But essentially what we're talking about here, first of all, this beggar thy neighbor approach never works because it's the global environment that does. But more than that, what it says is they don't really know what to do and they don't really know what's wrong. Das tried one thing, which was very different from Urjit Patel, his immediate predecessor had. And now Malhotra comes in and maybe trying something completely different, because none of the things that the government has done have actually produced those results. And that's just emblematic of the fact that what we're dealing with here isn't specific to India. It's not really about all the stuff that gets thrown around in the mainstream media. There are bigger fundamental forces at work that governments are trying very desperately in some places, like India, to counteract when it's well beyond their capabilities. And that creates another layer, another element of volatility in all of these different perceptions and angles. But why is India's currency going lower? I already talked about it as downside of supply shock, but many people say this is, trade wars, for example, because the timing does seem to line up. The Trump election, November 25th, was when President Trump and President-elect Trump put out his post on Truth Social saying that he was going to pursue trade restrictions and tariffs against a lot of different places, and he did eventually target India, which I'll get to in a second. But before we talk about trade wars in 2024, we also have to remember the US and India went through a mini trade war in 2019. In June of 2019, actually the end of May of 2019, the US removed India from its preferential trade program, which was known as a generalized system of preferences. And it did so because, as Trump said, India kept enforcing tariffs on US goods and products sent to India. Therefore, he was going to reciprocate with the same on Indian goods. And it went back and forth in this tariff for tariff spat. So we already had trade wars in June of 2019, but remember, the financial and currency chaos in the rupee and in the marketplace in India, that all happened in 2018, not 2019. So you could argue that it may be that the markets were upset in 2018, as a lot of economists did, based on the promise of trade wars to come. And eventually they called it trade war sentiment in 2019 when it finally developed. But it doesn't really explain how far the currency fell, the rupee or other currencies around the world in 2018, nor does it explain the downturn in the economy that had already developed, and by economy, I mean the global economy, that had already developed even before we get to these restrictions, whether it's China, India, or anyone else, which is why economists had to start referring to it as trade war sentiment, because they realized the actual amount of tariffs and restrictions were just a drop in the bucket and could not possibly have explained the weakness in the entire global economy, the local economies, whether it be China and India as well, by just the trade wars or trade restriction, the imposition of tariffs. So keep that in mind as we go forward here. We've already gone through trade wars with India, and it was not the cause of at least 2018's financial and monetary upset back then. But we do have to note the coincident timing. As I mentioned, the currency got a little bit weaker after the US presidential election, and it also got a lot weaker and started on its parabolic drop that we're getting into here on November 25th, which was that Truth Social post. As the Business Standard reported, speaking with reporters at Mar-a-Lago, Trump criticized India's steep tariffs, including a 100% tax on certain U.S. products, and warned a tit-for-tat approach if these practices persist, just like in June of 2019. I've always said, if they tax us, we tax them the same amount, Trump remarked, signaling a tougher stance on India and other nations like Brazil for imposing high tariffs on U.S. imports. His comments form part of a broader discussion on the state of U.S. trade relations with major partners such as China, Mexico, and Canada. The word reciprocal is important because if somebody charges us, India, we don't have to talk about our own. If India charges us 100%, do we charge them nothing for the same? Trump stated, reiterating his view that the U.S. should impose equivalent tariffs to address these imbalances. And while that's likely to make the situation in India more questionable, if not worse, again, it doesn't explain everything that we're seeing here, just like it didn't in 2019. It certainly doesn't help from the Indian perspective. It creates more uncertainty. There is that trade war sentiment. That's a very real thing. But it cannot be the sole reason why we're seeing everything that we're seeing in India, up to including a real downturn in the currency, now impacting the stock market, and economic weakness that goes beyond either of those things. Those things are reflections of the fundamental situation in India, which is slowly being revealed in the same way that we see in places like Brazil, as well as China, and maybe even the US too. And that was characterized in the Indian government's downgrading of its economic forecast, and serious downgrade. And it downgraded the forecast to around 6.4% GDP growth for the upcoming year, which sounds terrific, but it's actually, first of all, a recognition of how things really are going over there and and how it fits into this global cycle that we're seeing. But it's also 6.4% is not what India requires in order to meet not just the goals of the government, but really the transformation from taking India where it is to where it really wants to go. As Bloomberg reported on January 8th, so not all that long ago, worries are mounting that faster growth was a post-pandemic demand blip. For years, India's booming economy fueled exuberance that the South Asian nation had entered a new era of faster growth, powering its markets to new heights and raising expectations it would exit the trenches of developing nation status in a few decades. Now, a deepening slowdown is raising concerns that a 3-year boom was not the start of a new era, but a blip, and that sounds really familiar. The latest government figures show the economy will expand at a 4-year low of 6.4% in the current fiscal year, a return to a slower pre-COVID norm. And that's the best possible view that the Indian government can come up with. So if the last couple years were just a artificial high, and again, this is a common theme around the rest of the world, what next? That's where this uncertainty is coming from. We were promised this brand new transformation. In the United States, we were promised a recovery. In China and everywhere else around the world, they were promised a stable 2020s after the turmoil and downturn and silent depression of the 2010s. So if coming from that great expectation over the last couple of years, you can understand why markets are uncertain, to put it best. Now what? That's the question. India was growing gangbusters. It looked like it was accelerating its transformation. Now that it appears to be just a transitory blip, now what? That's where this weakness is coming from. It's not the Fed, it's not trade wars, it's everybody trying to deal with that same thing at the same time. And that same thing is the artificial high of the last couple of years, leaving everyone to now ask, as we enter the mid-2020s, now what? What is the rest of the decade really going to look like? And it's starting to impact financial markets like stocks. Just today, as the stock market in India crashed, here's what Bloomberg reports. The pace of earnings estimate downgrades for MSCI India components is at its fastest since mid-2022, at least according to data compiled by Bloomberg Intelligence. This trend could accelerate as more companies announce their third quarter numbers. That's a warning from JM Financial. Amid a slowing economy, many companies are likely to struggle to report numbers that defy the weak macro environment. And with private sector investments yet to pick up, investors are once again looking to the government to play savior by bumping up its infrastructure spending plans, which is a tremendous mistake. We created an artificial economy in India and everywhere else, and we want the government that created that artificial economy to make it even more artificial moving forward. I mean, that's what's happening in China, and markets are revolting against it. Because, as I said in the introduction, it's a product of failed assumption. The government's locked everything down and then said that they could flip it all back on, just like flipping a switch, with all of their stimulus plans. And as we're seeing over the last couple of years in particular, it doesn't work that way. Distortions really are distortions. In many ways, they were unproductive and ultimately harmful, the lockdowns themselves. So we went through this period of artificial high. Everybody got used to the idea of recovery, and now they have to get used to the idea that they were wrong in that assumption. A big part of that has meant a retreat in trade. So countries where trade is a huge part of their economies, especially at the margins, like places like Germany and Japan, because trade's really where we see this distortion and balance over the recovery to begin with. That's where it really starts. And India is actually on the other side of this. They import far more than they export. But it doesn't help when their export businesses are suffering the downside of the supply shock far more than the import side, where India has to import oil that's becoming more expensive again, and they import a lot of gold. But according to the last figures that we got from the Indian government, they imported a lot of stuff in November that created an enormous trade deficit, which goes along with a falling currency, because when you have an enormous trade deficit on the global marketplace, that means you need lots of dollars to pay for all the imports. And if you don't have a lot of exports, that means you have to borrow those dollars from outside the country from the Eurodollar system. So the more you have to import, the bigger the trade deficit, the bigger the need to finance everything in the dollar system. So a huge, enormous trade deficit at a period where India is at its most questionable, at least up to this point, of course that's going to lead to a lower currency, higher liquidity risk premium, higher risk premium overall to lend dollars to a place that needs more and more of them. But now the government says, nah, never mind, our bad. We double counted a tremendous amount of gold imports. We're talking about 5 billion here. According to the latest report, gold imports for November were 9.84 billion, at least data on the government website said, compared to the record 15 billion, or nearly 15 billion, published previously by the Commerce Ministry. Based on the new figure, India's trade deficit for November was 31.83 billion, according to Bloomberg calculations, compared with the previously reported 37.8 billion. So a huge change. And India's widening trade deficit has put pressure on the currency, as I just said, which weakened almost 3% over the past year and hit a record low of 85.87. That's last Wednesday. It's now down almost to 87 to the dollar. And while the government hasn't officially shared a reason for the data discrepancy, Bloomberg had reported that officials had earlier double counted some gold imports. It's a little too coincidental for me. My own opinion, sort of like China and its retail sales, it's a little too convenient as well. You have the currency that's falling. Officials are blaming psychology, bearish speculators that are hammering the currency. And so they're desperate to sever any type of psychological link to the downfall in the currency. So why not take the data that showed one key reason why the currency would be fundamentally weak and just rewrite it? Now, I don't know for sure that's what happened, but I mean, you have to be somewhat suspicious here on everything that's been reported, up to including the idea that they double counted $5 billion worth of gold imports, which again is incredibly hard to do. The fundamental pressures on the rupee, regardless of whatever government data says, remain anyway. And those fundamental pressures are not the Fed. They're not really trade wars. Trade wars don't help in this situation. It's really about, as I keep saying, the downside of the supply shock. That's what we keep getting all of this evidence for. That's what the volatility is about. That's what lower currencies are. Higher degree of risk because we didn't recover from 2020. Just like we didn't recover in the 2010s from 2008. The entire global economy keeps ratcheting lower with each successive decade. And India is a perfect example of a country trying to deal with a different reality than was hoped, expected, and advertised. It's got the crashing currency, we've got falling stocks, major questions on the economy, huge fiscal deficits that are not leading to private investments. Private investments are critically missing. We've got banking problems. I didn't even get a chance to talk about those. We've got liquidity issues that are sparked by officials trying to put out all of these fires that, rather than putting them out, continue to seem to spread further and farther afield. That's the point. Every time they come up with an answer, it doesn't actually fix or solve or really even deal with the question at hand. Because governments intended to prop up their economy and then remove those crutches and allow the private economy, expecting that the private economy would flourish. And then there'd be parades for all the government officials who were courageous enough to rescue us from their own creation, the lockdowns and everything else that went along with them. Instead, what we're getting is the messy sense that the messy transition from that artificial high to whatever lies next is going to be messy, because it already is in a lot of places. And India's rupee is a canary in the coal mine for global health and its condition. And as it continues to go lower, now without Das, the previous RBI governor, to artificially suppress its volatility, now that it may be poised to go a lot lower, a lot faster, the uncertainty goes way up, the volatility goes way up, and it's all for the same reason: downside of the global supply shock. Volatility in India's currency, volatility in China's currency, as much as the PBOC will allow it at this particular moment in time. And I talked about that video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.